Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, December 22nd, 2023. It is 11:21 a.m. Eastern Time. I'm starting the video, and what I'm going to do in this one is cover primarily commodities. If time permitting, I'm going to get into the equity markets, but I have a feeling by the time I go over these charts, we'll probably be getting a little long in the video, and I don't want it to run much over 30 minutes on this one, so 40 at top, so I'm going to try to keep it under. So again, if I don't get to the equity markets, I'll do that in the next video. What I want to do is go over the weekly charts, look at the sectors of the S&P 500 as well as the Mag 7, and both from a short and long-term perspective. So that'll probably be a video number 2 today. All right, so we're going to look at commodities. I say this often, diversification as well as asset allocation to me are every bit as important in trading, active trading, swing trading, as they are in investing. For those who are not familiar, diversification says don't put all your eggs in one basket. Don't buy one or two stocks, one or two sectors. You want to own, diversify. What that number is, it's up to you. What's manageable. It depends. Are you trading individual stocks? Well, that's much more important. You don't want to have 3 or 4 only. Are you trading ETFs that have, already have 100, 500 stocks like SPY? So there's a lot there. But the bottom line is that's diversification, having different positions. However, very important that you understand that make sure you are actually diversified. A lot of people think they are when they have Apple, Microsoft, or NVIDIA, Meta, and the likes. And really those are highly, highly correlated trade. They're all big tech, Mag 7. They go up and down based on buying of the futures and the ETFs and the market inflows and outflows. So for the most part, they're going to move together. And you're not diversified even if you own all 7. In fact, you could own all 100 companies in the NASDAQ 100, and they all tend mostly to move together. So, that diversification is different sectors, stocks with low correlations, different business models, and then asset allocation. Stocks are just that. They're stocks, they're equities, ownership in a company. Your different asset classes are stocks, as well as bonds, and within bonds you have different flavors: government bonds, corporate bonds, investment grade corporate bonds, below grade, aka junk bonds, muni bonds, etc. We can go on and on. So a lot of ways to diversify there. Another asset class, of course, is commodities, but even within that, and we're going to focus on that one today, you have a lot of commodities that have absolutely no relation or correlation to each other. Like sugar has very little, if anything, to do with gold. So let's get into the charts here, and I'm going to give you both trade ideas as well as analysis. But I'm going to start out with gold and silver. I haven't been covering it a lot lately. My convictions haven't been super strong on it. We've had, with the central banks lately and everybody focused on interest rates, we've seen some volatility in the currencies, which have led to volatility in the metals, of course, because they are, especially gold and silver, very, very strongly correlated to the price of the U.S. dollar index, inversely correlated, meaning they go up and down opposite one another inversely. Or you can just use Euro USD, which I'll get to in a second. So here's big picture of gold, just to kind of recap. This was the last true big bear market in gold back here, or the previous one, off the 05 lows right there into the highs in 2011 with a blow off top. Then we had a bear market in gold that ended back in late 2015. Then we had this long basing period really for a couple of years. And then the beautiful breakout right there was highlighted at the time, 130 being the big level to take out. And when gold took out 130, it never looked back. That gave us a peak right there in 2020. And so this can be viewed as one of two ways: high-level consolidation. Now, remember, gold's still trading, or at least GLD, the CTF, where it was all the way back in 2011. And we are still coming off the heels. Yes, inflation's been coming down, but we're still coming off the heels of the most hyperinflationary environment, or the hottest inflationary environment in nearly half of a century. So therefore, that, should have probably, all other things being equal, put a stronger bid in gold. But again, gold is influenced very, very largely by the currencies they trade in, and that's simple. It's just the pricing of it. You're buying gold. If you're buying GLD, you're buying it in U.S. dollars. If you're over there in Euroland, then you're going to buy it based in euros. But when the dollar appreciates, it's stronger. It takes fewer dollars to buy an ounce of gold, and likewise when the dollar's weak, it depreciates. It takes more dollars to buy 1 ounce of gold. So that's what causes, a falling dollar to make the price of gold go up. So we always keep an eye on that. But you can see this is just a big range. And when you zoom in, remember that was the previous top. You had a couple pops above that level. 1, 2, 3. So this is really now the ceiling, the big level. I mean, massive level. Everybody sees it, knows it. 180. We'll call it about 185-ish, 193. I'm sorry, 193-ish. And there's a strong. I'm not going to sit here and talk all about it, but there's quite a strong fundamental case for gold longer term bullish. However, the charts, like I said, if it breaks out, a breakout is a breakout, like I often say, unless it fails. So there's a level. If it breaks out, you can take it. You can do what you want. If you think it's going to fail, don't take it. Wait for a failure to short it. But if it breaks out and you take it, just don't get married to it if the breakout fails. Now, breakouts will usually come back. From my experience, once in a while you get a perfect back test of the breakout level, but quite often they're going to run it down through to blow out the stops, the weekend and longs that took the breakout, suck in some shorts that think the breakout fails. So I like to give my positions, especially if it's a long-term position, a little room there, and a little is up to you, depending on what you're looking for. But again, that's powerful stuff. If it does break out, a solid and sustained breakout above this multi-year trading range would obviously be very, very powerful. And all eyes will see it. It's, again, everyone knows gold's pushing up against those multi-decade highs right there. And likewise, you can see on the chart, we've been diverging. I called this ADH almost divergent high because you were slightly lower. The metal itself I might look at. Gold, GLD does a really good job of tracking gold, so it's going to be close. But either way, you have these equal highs right there, and any marginal new high anytime soon is guaranteed. Again, anytime soon is the operative word here, is guaranteed to be a divergent high. So keep that in mind. And so I'm kind of meh. Well, I'll be watching the Forex, the currency, and I'm going to get to that in just 1 second. Let me just zoom down to the daily chart. Busy board. You can see some divergences there at this most recent high. See, there's our previous high was a divergent high. Here you had an island top that set us down. Island tops are major topping patterns. They're separated. It's a big candle separated by gaps on both sides after an extended run. They're topping patterns. Here you had a divergent low, positive divergence. We were long and strong there. Divergent high. So that's kind of the what gold's been doing. Divergent. No, not a divergent low. Take that back. Not on the daily, at least. This is divergence right here. And we had a little drop, pushing back up. And again, any equal or marginal new high anytime soon. Again, anytime soon being the operative word, because if we do this for a while, this is all going to change. But if we happen to pop up and equal or pop above that high anytime soon, you're going to have this divergence here on the daily as well as on the weekly. That's why I'm a little cautious right now, and just I'm a spectator. I think I've told you that recently. And there's times where I'm trading, I'm putting trade ideas out, long short, GDX, silver, gold, all the time, and I'm just a better fish to fry lately. And it's also, you can see the kind of choppiness here. So there's the 60-minute chart. That was a divergent high. You even have another little divergent high here on the 60. So I'm a little cautious right now on gold, but it's within what I like to say spitting distance, if you will, of breakout to all-time highs. And so keep an eye on that, and then watch the price action and see if those divergences get taken out, see if the volume's good, see if the breakout holds, see if there's a back test, if they come in and buy the back test, stuff like that. So it's kind of longer term stuff. Silver, SLV, again, this looks like an EKG. This is my 60-minute chart. You can see all the little divergent low, rally, divergent high, correction, divergent low, rally. Another larger divergent low, it just extended the previous divergence, rally. Divergent high, divergent low, divergent high, divergent low. Another divergent low, rally, divergent high. Divergent low. Divergent high, and that's where we're at. So we're in this little EKG here. We're going sideways. If you're quick and nimble, absolutely. But look, here's another divergent high right here, the most recent. So put a gun to my head and I had to have a position, it'd be short. Maybe, who knows? We'll see what I do next week. But right now, just wanted to give you an analysis because I know I get a lot of updates for it, and requests when I'm not updating it actively or trading it actively. There's that range. You can see it pretty well. Had a little false break to the downside there. little false break to the upside, but that's where silver's been trading now for pretty much the entire year. You can go back here. That's a 60-minute chart. Weekly, that's what it looks like there. If gold breaks out, it'll follow. Silver will always ultimately follow its big brother gold. All right, euro, US dollar. I'll get to the futures. Let me just give you the euro, US dollar first. This is long-term stuff right here. Here's your primary. This is my weekly chart. Oh, that's not what I wanted. I want to just kind of highlight these downtrend lines. This primary downtrend line right there. We're still way below it. This was a major bear trap, false breakdown above, below that key support level. Whipsaw, we're back above it now, but that's very long term. Most of you probably want to know where we're going today, tomorrow, next week, not next year. This is the uptrend line right here. We bounced off recently. This is a daily chart. We bounced off it here, had numerous reactions. I have a little minor trend line right there. We do have divergence. So this is like gold and silver. What I just showed you, the euro confirms it's in a near-term uptrend, but it also has some pretty solid negative divergence that will not be taken out anytime soon. Now, it could ultimately be taken out, but we have some resistance not too far overhead. And even when you jump down to the 60-minute chart, let me just borrow this one, duplicate that. There it is. So you can see, wash, rinse, repeat. We had a divergent high right here, followed by a correction. We shorted gold in the euro. I gave you these 3 targets. My third and final target was hit. Made a slight pop below it, put in a divergent low. I highlighted that. That was a catalyst for this rally. And that was a rally. And by the way, the stock market's highly correlated, very highly correlated with this as well. Showed you 100 times, but I'll just do it again, put on here. Here's QQQ. Now, the candles, you have a line chart on QQQ, and the Euro USD pair trades around the clock. So that's why you're seeing a lot of flat lines, but you can see the trend. When the EUR USD is falling, QQQ and SPY, the US stock market's falling. When it's going, they both go up and down together. They both peaked here. Again, they're not on the same scale, so you're not going to see a move. They both bottomed here, and they've both been rallying. So, surprise, surprise, nothing's changed for me on my outlook for the equity markets, despite the fact we're green today by a small amount. Just wanted to show you. This is a big one to keep an eye on, whether you're trading gold, silver, GDX, or the stock market. And if those divergences play out, which I've been stating lately, I think we're coming back down for another run at this trend line here. At minimum, this one right here, this uptrend line, that first one, possibly that other trend line there. And if it gets really ugly, we've got some pretty good support around 105, 288 down here. That would be a pretty sizable drop in the euro and almost certainly bring the U.S. stock market and gold and silver down with it based on their high correlation. GDX, it's been rocky, but more like an upwards EKG, unlike silver going sideways. And that is, I believe, one thing attributed to that is the fact oil has been down. Remember, the miners, I often say this kind of jokingly, but it's true. It's not. We're not in 1849 anymore, where you're in Sacramento panning, grabbing gold off the little, one of those little gold pans and taking it off the top of a creek bed. We've long stripped the earth of its surface gold, and you got to go deeper and deeper to get it and move more and more earth. That's very energy intensive. And so the miners, one of their, I believe it's just like the airlines, second biggest expense is energy, fuel, where first being labor. So correct me if I'm wrong, but it's something I looked at. So I like to see, when you see falling energy prices, falling crude oil especially, then that tends to give a help support a case. But make no mistakes about it. GDX will follow gold. I always say it's simply like a leveraged trade on gold. It goes up in up and down in a multiplier of gold. It's not a set formula, but it's usually at least 2x. Meaning if you get a 20% rally in gold, you're probably going to get a 40% rally in the miners, and vice versa when gold drops. So that's why I cover all the charts together. And so, right now, all I can tell you, go off gold. Oh, you do have, just like gold and silver, you've got the divergence. So again, put a gun to my head, I'm shorting them. And maybe I will short them next week but it's Friday. I'm not gonna, no reason to start any new. I have enough stuff right now to take home over the weekend, which I'll get to in a second. So there it is. I'm gonna borrow that divergent high, duplicate that, and just put it right there. And remember, divergence is not a sell signal; it's merely an indication. Sell signals will typically come on breaks of support, bearish or bullish chart pattern, or sell signals on bearish chart patterns, et cetera, et cetera, et cetera. GC for you futures traders. This is an hourly chart, 3 months. You see divergent high, beautiful. See, there's a good example of a sell signal. You had a bearish rising wedge here, negative divergence building, and then you got your sell signal came on a break of the wedge right there, the trend line. You went down and downtrend, look for those divergent lows to start getting ready to cover and go long, and then you had a buy signal in the breakout. So short, long, blow off top, talked about it then, went down, put in a divergent low right there. There's your positive, aka bullish divergence. There's your rally, and here's that negative divergence I just pointed out on GLD. And silver has it too, as does platinum and palladium. Or I should say, as do platinum and palladium, excuse me. All right, so there's, same thing, divergence, negative divergence, correction, positive divergence, bullish divergence, rally, negative divergence, correction. And another rally ended in negative divergence, correction. Beautiful bullish falling wedge, explosive breakout right there. And now we have this wedge. You have the negative divergences I've been pointing out on the ETFs, and these are the futures. There's an uptrend line in which to trigger a sell signal, and you can see my first two support levels, potential targets right there. I don't get too many requests from the site for the palladium groups of metals. Those are palladium metals are platinum, obviously palladium itself, and rhodium. But I trade them, and they're just not as liquid, the futures, but they do have ETFs. I'll get to those in a second. This is palladium PA. There's your, again, pretty clear negative divergence, just like you had bullish divergence at the low here recently and gave you that rally. So if we pull back, there's pretty nice, decent, not great, but decent support. And then if it gets a little uglier than that, about 1095 would be a even better support level area to cover a short and or go long if we get down there and you take it. And for your ETF traders, PALL, this is the physical palladium shares ETF. Just a nice clean. Now that was bullish right there. You put in that divergent low recently. Nice strong positive divergence. Yeah, these things do work, guys. Divergent lows and highs, not all the time, but more often than not. And that was also a nice target resistance level we took out. We're just above it now, but consolidating. Maybe it's some flagging action. We power on through, but it's just not objective right now. In my opinion, based on everything I just covered, the divergences on the 60-minute time frames and all that, and you have the overbought. Last time you were overbought was right there, and if you bought palladium at that point, that's what followed. So be careful. Now, again, mixed bag, because we're coming off a divergent low and took out that downtrend line. But when you look at the 60-minute chart, you can see I have to zoom in. We'll get even if we get another thrust up anytime soon, we'll still have divergence. And sometimes, look, when something wants to run, especially like this guy here, palladium, can run. It's kind of like natural gas. When it wants to run, it can just keep running. Sometimes it'll burn through those divergences. I just don't think it's objective right now to take on the long side. And then PPLT is your platinum ETF. If you want to trade platinum with via an ETF. There's the same thing, divergences, just like you had the bullish divergent low recently right there. And daily chart is, there it is, big divergent low, and that was a rally, but also right into resistance. So again, put a gun to my head, or maybe don't put it. Maybe next week I'll just short them because I want to, because I've just showed you a lot of them have divergence, and some of them like platinum right here, PPLT is at resistance, so maybe get a pullback. Look at that beautiful island top right there. We had that in gold too, I highlighted earlier. Okay, crude, I threw that out as a long trade idea a week or so ago, and we were coming off this divergent low. This is USO, the ETF, even long short, always, crude oil is rarely a, long-term position. It's a trading vehicle like natural gas. That's it. So, okay, well, I want to show you here. We're at this, this is USO, this is an ETN, very liquid, does a good job, but it's not perfect to track, and I'll look at futures in a second. But there's a downtrend line right there. A little bit of divergence starting to form here on the 60. If it can pop through there. But again, I like to, personally, I trade crude futures. There's 24/7 liquidity. You can use stop loss orders and get don't have to worry 3 a.m. if there's a huge explosion and the price of it and it goes against your position, or implosion. You get you don't have to wake up to a giant gap down like you do in USO. Tax benefits, you name it. But let me show you the crude. Okay, this is CL. I mentioned buying it here a week or two ago. Gave you a few 1, 2, 3, 4 targets. T1 was hit here, and then we consolidated on it. Then we broke T1, popped right up to T2, hit that, pulled back to T1. So if you took profits there, you could have recycled back in there, ran up again. But then recently we put in a divergent high. And if you see what I've drawn out here, so I'm a little bit meh right now on crude. We are still coming off that big divergent low, but you can see we've been diverging. Then we broke down, we back tested, and we're below that wedge. So, if you're in it, this was the stop I gave you last week or whatever when I gave you kind of my trading plan, and some of those stops I've modified on the indexes and bonds and other things. It's, I can just tell you, if you trade the week heading into New Year's, long bull or bear, long or short, you're probably going to get stopped out in just the low volume volatility and grind. It's a field day. The market makers and the powers to be and algos can have a field day. If you give me enough money, I can run stops. Give me enough, again, a trading desk where I can pull prices down. No, they know where the stops are. They being the nefarious forces of Wall Street, the big trading firms. And so, I kind of tend to be a little, liberal when you get up into that final week between Christmas and New Year's on stops, or just don't trade, because again, maybe it'll go your way, but my experience more often than not, they're just going to run your stops especially if they're tight. But either way, at this point, if you took it, no reason to let a winner go into a loser. So probably ratchet up stops to a little bit below that T1 in case it pulls back at most. And if you took profits at here or here, then wait for a pullback to that level and then maybe go long again. We'll see. I'll update it next week. Right now, I'm just, like I said, I'm not super crazy about the fact it broke down below that trend line, back tested, and it's moving below. If it can power on up here through these divergences, absolutely. It's going to open the door to T3 and T4 and maybe more than that. We'll see. And also, remember, by the way, you got the Bull Brigade singing the bull song right now. And I mean, I'm talking everybody. I don't watch much TV, but I do. I've been reading a lot of articles, and I do turn the TV on to when the reports come out, economic reports and the likes, or if there's a movement in the market. And wow, the bears have left the building. I mean, everybody's calling for a great 2024, soft landing with no recession, lower rates, better economic earnings. Oh my gosh. So anyways, whatever. My point is, okay, if that's going to happen, then you should see crude start to catch a demand bid. In other words, stronger economic growth leads to demand. Crude prices have been down. So, if not, and watch it. If it starts going the other way, it's telling you why is crude dropping? We've saw this conflict. We haven't had this much conflict in the Middle East in a long time. I mean, some pretty serious stuff too. So, anywho, whatever. You can view it, like I said, as what I'm getting at is an indirect hedge. Sometimes that work does, and sometimes it doesn't, to a stock market position, whether long or short. Primarily, I'm talking about if you're long-term short. But again, short selling. If we go up much more, I'm going to get to that in my next video with stocks. We're really where we're at, where I said before, months back, my alternative marginal new high scenario in QQQ. We're there. Most indexes and the majority of stocks have not made new highs. But looking at the charts and the setups that I have and and again, I'll go through this, the turn, if it's going to come, needs to come very soon. And right now I'm seeing nothing but good economic numbers that are supporting the bull case. And yeah, I hear the narrative. I hear it loud and clear. And that's why I told you the other day, I've never called for a black swan event, but I suspect and I have more faith in the charts than I do in the fundamentals and in the talking heads. So I suspect something is right around the corner. And if it's not, guess what? I'm wrong. We're going to burn through all these divergences and resistance levels I have and things like that. And maybe we will have a great 2024 or even the first 6 months of it. But based on my charts, I don't think we're going to make it that far. And then it's based on, again, where all the economic data is coming in lately. Something's amiss. Something doesn't jive. So maybe there's going to be a kind of a quote unquote surprise at maybe a big financial or non-bank financial. Okay. Up next, covering a lot here. Natural gas. Maybe you didn't see it. Check it. Last night I gave you a update on natural gas. But then I followed up in the comment section this morning. I realized I'm in the February's, but I still had a chart up of the January's. These are futures. They roll, natural gas futures. You can roll them every month, and you can trade any con. You could trade the March right now if you wanted to. The February's have the most volume, and so most traders have rolled from the January's to February. And so my point being that yesterday, I think it was, if memory serves me correct, I think it was 260. These are the same exact levels. What I'm talking about is I look at the reaction points, but I've put this chart out because if you're going to take it, we still haven't broken out. Even on the other one, the January contract, it was, I think, it was over that previous high right there. So we don't have the breakout yet. So that was a setup I gave you yesterday. When we took it back here, I posted a week or so ago, gave you a stop. I forget where it was, somewhere around there. Obviously, we already hit, this target here. You can, raise your stop at this point would certainly be prudent. And I just want to say now, if you're trading futures, I'll get to UNG in 1 second. That doesn't change, but that's the levels now, or these are the levels. 250 is the breakout point we need to see. Ideally, you want to see it on volume, and it'd be great to see these potential divergences. And you know what? We're stretching. I think we will. If we can get a sustained breakout, they rallied up, tested it again today. And if we can do that, then the divergences should be burned through, and then this divergent low could be the catalyst to run us up there. And the trend line changed again. That had the trend line before because each futures contract has different prices. Especially natural gas, more so than stock futures. There's always a premium or discount in things, but in natural gas, that premium or discount over spot prices can be considerable based on, because natural gas, has storage issues. Can't put it in a tank like, crude. When we're sloshing around in more crude than we know what to do with, they're filling up the reserves at Cushing and, strategic reserves and all that stuff. But so that's why natural gas futures are going to vary from month to month. So that's it. Just want to point out, no breakout yet, but I'm certainly on watch for it, and kind of looks like it's probably going to happen is my guess. But unless it does, it's not a breakout. And nothing's changed on UNG. That's still the same. That was T1. We're long back here. T1 was hit, and we need to pop above that level to hit T2, T3, T4. And you know what? I'm going to do it now. Let's make it official. T5. We haven't broken out yet, but why am I adding that now? Well, if you're if you think there's a good chance it's going to do that, and you're going to take the breakout, or you're already in it, let's just say you're not in it, or you sold at T1 when it was hit, you recycled back in on the pullback. That's what active trading does. That's why I list these multiple targets. That'd be about a 28% run. So you could give yourself a wider stop than the person that's only targeting T2, which is only from $5 to $5.23. That's only a 5% pop. All right, moving on to a different type of commodity, your agricultural commodities. Wheat. Wheat was all the way back here off that divergent low, thrown out with the trade idea with all 5 targets, 1, 2, 3, 4, 5. We hit the first one, we pulled back, put in a marginal, slightly new low, nothing in even close to exceeding a reasonable stop based on an attractive RR to T5, so it's still that same trade, or I've been highlighting again, you can take it here. And that was the stop I suggested the other day, last week. And we hit T1 again. That just further validates that as resistance, and we've been consolidating in this range here. And so it's simple. Just like nat gas needs to pop that level I just gave you a minute ago, wheat needs to pop $6 and to open the door. And remember, it still looks very constructive on the long-term chart. Of the mindset that I feel pretty strong on this, that okay, so let's say my market call's wrong and 2024 is a rocking year for the stock market, right? And economic growth, you're going to see a return. This is, to me, the risk reward is so much more attractive in commodities, but I'm also very selective. I'm bullish on long wheat right now, as I showed you, natural gas. And then let's get to the next one. OJ, let me give you an update there. So you see the levels, and again, you also see this was also trade back here. T1 hit, T2 hit, T3 zone, T4. So those are longer term targets on wheat. And this one was given to me, or at least put on my radar by a member of the site who was back here, and I told them I wasn't going to short it because I couldn't see a case to short it. And their point was it was going up and it was going to so strong. And so pulled the chart. I shared this one with you. We shorted it literally with, just like our treasury bond longs recently and covering our index shorts and all that with impunity right at the lows. Same thing we shorted, or I did throw it out to you guys that day. It's up 25% since then. And what I said is I've done this for a long, long time, guys, and I've never yet maybe one day I'll see it. I've never seen a parabolic advance. That is the definition of a parabolic trend line. And I've never seen one end well. And you can see going back, when I roll back here, I gave you, for simplicity's sake, if you want just one sold target, and we're only halfway there. But again, haven't heard from much on this. I update it from time to time, and anyone's in it, let me know. If not, I'll just stop updating it. But and that's up, like I said, 25% since the end of October. I have a different board here too. I showed you on that one. I had the parabolic trend line. Here's one with a linear trend line, and just an alternative. When you get parabolic trend lines, you're going to have a series of the linear trend lines will go like this, and that's the whole nature of a parabolic uptrend. But that's it right there. So you can see that minor trend line, and then we just broke this secondary trend line here, and that's where I had those targets. So I give 3 targets here. It's more of a target zone. And again, the takeaway here is part of diversification and asset allocation is having different trades and different asset classes. But then at the very same time, as I said, when you delve into, like I said, commodities, for example, their charts are so different because there's no relation whatsoever to gold or orange juice futures. And so you can be long one, short the other at any given moment. Another one I have for you here, which I actually like now, is sugar. Okay, sugar, this is a 60-minute chart. So you've got hourly candles, 3 months of price history. There's your downtrend line. There's your divergence line, and that gives you this bullish falling wedge pattern right there. Targets, 2168. Again, unadjusted. These are actual resistance levels. All right. Unadjusted targets, I'm sorry, took a phone call there. 2168, meaning actual resistance. Always put your sell limit order a hair below the level you're targeting. 2239, 2310. And that would give you, I think it's like 8% maybe? No, 12%. A little better than 12% to that third target. No buy signal yet. Buy signal coming to break the trend line, but looking pretty good. On the ETF front, there used to be SGG. Was unfortunate earlier this year. iPath redeemed a lot of, just closed out a lot of their ag ETNs. I'm sorry, technically, and so, but this one still has an alternative. I used to always think SGG had a little more volume. Kane is the other one. So you can see Kane here had this bearish rising wedge, and I'm not mistaken, I think I highlighted that as a short trade idea back then. But there are no buy signals. It's a solid downtrend right now. But look at that extreme oversold reading. Last time we were that oversold was right here. And I guess I didn't even know to cue it up in this video, but I would have pointed out this. These are all notes from back then in 2020. This inverse head and shoulders bottoming pattern, left shoulder, head, right shoulder. It's hard. You'd have to zoom in. Only I can do that for you here. And then boom, and there was our long entry. And we might have been in front of it on that because off that divergent low. And that was an epic entry for sugar. And again, it was my whole commodities, new bull market and commodities theme, as we came out of the COVID lows. And that was it, 211%. So, again, you can go back as long as you want. You can see by all metrics, these commodities are in what appears to be a new bull market. By all metrics, meaning it's simple. A trend and uptrend is defined as a series of higher highs and higher lows. And you've taken out, you've been making higher highs and higher lows. And you've taken out the previous bear market lows. So, and what you do with that is you recognize you're in a bull trend, and then, you might want to step in a little earlier than later. In other words, you can buy in a bull market. Oversold is usually a gift. Usually it's one and done. And you want to buy it. In a bear market, oversold can and often becomes more oversold. Either way, this trade was based primarily on the 60-minute chart I just showed you. Let me see on Kane itself. I didn't mark it up, but I'll do it for you. There it is. Just remember, these ETNs can be a little bit of a pain in the ass at tax time, but if you've traded them, you know, you get the K1. It usually comes later than all your other tax info. All right, there's. I haven't marked up levels, but you can see coming off a divergent low, looking at least good for a counter trend bounce, 12% or so, in my opinion. This one's Cocoa bearish rising wedge. So this one, you've been building divergence. Looks like a pullback target about 41, 44, give or take, about 3.5%. That's a minimum target. Not super crazy about it, but and I wish I could tell you, and this is what I was looking at. There's no more. To the best of my knowledge, we don't have a Cocoa ETN because iPath also redeemed NIB, which was for years we would trade this one. I mean, this one was we traded like played it like a grand piano or fiddle or whatever the saying is. Just back and forth with trend line breaks. I remember just going back here and trading it and posting these, ping ponging it, and it traded very well to the technicals, divergent highs off resistance. Anywho, it's gone. So futures are your thing or nothing at all. I'm not going to delve too deep into Bitcoin, but I did throw out a trade idea recently, and I still think it's been defiant. And that's also because the stock market's holding up. It's risk on again, like it has been most of its life, especially in the last couple of years. It's played a little game of on and off with that. Sometimes it's moving opposite the stock market, but normally it's moving, especially when the market gets a little frothy and the speculators come back in, like recently, and they play the meme stocks and they get all fired up again. But this is GBTC, Bitcoin Trust. I pointed out right here on this divergent high, still have a divergent high. I've ever so slightly tweaked the trend line is all I've done. So you need to take out that trend line. T1, you have an intersecting uptrend line right here. And T2, if we take out the trend line, because it's going to be a while. And what I mean by that trend line comes in now with T1, but you don't fall straight down unless there's a crash. You work your way down like this. And so by that point, you go like this. In time, the trend line is going to come in higher if and when we hit T1. So we'll see. We'll just have to see where it goes there, and then I'll let you know. But I think T2, I'm looking at the chart. There's a big thin zone. I think T2 has a good chance of being hit. And again, we don't have a sell signal right now. Zero sell signal. We need to take out the trend line. But if and when we do, it's about a 41% drop. And that's it. I managed to keep it under 40 minutes. This is the daily chart of GBTC. Remember, it trades at a premium discount to the actual price of a Bitcoin, but big negative divergences also on the daily, just like we had back here, divergent high, and we hit these 1, 2, 3, and third and final target to the button right there and reversed. So let's see if this divergent high, and there's your uptrend line. You can see it here on the daily as well. That's that same trend line I just showed you on the 60. So break that. T1 would be all the way down here, 24.37. That would be that's about the same, 35% downside. Okay, let me wrap it up here, and I'll put together the video on the equity markets, if anyone's around. The comments are kind of drying up. That might be a function of the markets just not rolling over, and I know it seems everybody, 99% of the comments have to do with the equity markets. And this is why I do these videos. If you're only trading QQQ or SPY, if you've been long lately, yeah, it's been a slow grind higher, slow and steady grind higher, but there's a lot of other opportunities out there. And, again, nobody bats 1,000. So you do that, you're going to have a really good month or quarter when you're only trading QQQ or SPY, and you're going to have some really bad months or quarters. And the whole thing is to have some other positions that offset the bad times. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.